Hi, everybody. I'm John Nersessian, Head of Advisor Education at PIMCO. Thank you for joining us for our discussion today around opportunities to reduce our current tax bill. Now, we know that taxes are an important concern to many taxpayers today, both to the advisors that they work with and the investors that they serve. In fact, a recent polling done of wealthy families suggests that while we desire help and guidance in many of the financial planning activities in our lives, taxes remain a critical or key focus. 89% of wealthy families want help and guidance in understanding taxes and incorporating tax planning into their financial planning efforts. But unfortunately, the large majority of these individuals are not receiving the help and the guidance that they seek. Here are a few ways in which we can consider lowering our tax bill for the current year. Opportunity number one is to increase our retirement account contributions. Retirement account contributions are not an itemized deduction, but are an above-the-line deduction that serve the purpose of lowering our taxable income and the associated taxes paid at the end of the year. Let's quickly review the numbers. Traditional and Roth IRAs, annual contributions with a catch-up contribution opportunity for those over the age of 50. 401k, the common form of employer-provided retirement accounts. Another unique advantage of the 401k plan is that many of them afford or offer an employer match, accelerating or leveraging our retirement account growth opportunity. Those who might be self-employed can consider something like a SEP plan. And for those who are maybe a little bit older and earning higher levels of income, might contemplate instead of a defined contribution plan, a defined benefit plan, affording the opportunity to set aside savings for our retirement preparedness. Our second tax saving strategy is to take advantage of those unfortunate losses that exist in our portfolios. We know that capital gains, long-term in nature, are taxed at 20%. Short-term capital gains are taxed at a maximum rate of 37%. Both of those are subject to the ACA tax of 3.8% for families at incomes of $250,000 and above. So what do we do to offset gains that have been realized in our portfolio? We may contemplate the realization of existing but unbooked capital losses that can be used to offset the gains that were already realized. Here's the methodology. We start first with short-term property, and we use short-term realized gains against short-term realized losses, producing a net short-term position. We then transition in step number 2 to focusing on long-term transactions, property held in excess of 12 months, once again netting out gains versus losses. The third step, of course, is to combine the two together, recognizing that losses can be used on a dollar-for-dollar basis against gains. Any losses earned or achieved in excess of that amount can be used against ordinary income. Any number in excess of that amount can be carried forward indefinitely for future tax reporting years. The third strategy that we want to reference is charitable giving. Now, we know that itemized deductions are rather limited under the current tax code. Those itemized deductions under Schedule A include the following: medical expenses, but they're only available as an itemized deduction if they exceed 7.5% of our adjusted gross income. State and local taxes are an available itemized deduction, but under TCJA, that deduction is capped at a maximum number of $10,000 per year. The third item is mortgage interest if we have a mortgage and if we are itemizing. But the fourth opportunity is our charitable giving, which remains a very popular itemized deduction for many high net worth and affluent investors. The question is, how are we giving? Are we giving reactively when solicited, or are we giving intentionally to maximize the benefit of the giving that we're already engaged in? Here's a perfect example of bunching our deductions under charitable giving to produce an even greater tax benefit. Let's assume that we give annually $25,000 to our favorite charity. That, of course, is an itemized deduction. And let's start our examination in blue with an individual who has $10,000 of SALT taxes, no mortgage interest, and an annual charitable contribution of $25,000 per year. The total itemized deduction in all 4 years is $35,000. That exceeds, of course, the standard deduction of $29,000 by a modest amount. Our client, of course, in this scenario, will claim the $35,000 figure in each of the 4 years, producing a total deduction of $140,000 in this 4-year period. But let's take a look at a client who's similarly inclined, who's giving a similar amount of $100,000 over the 4 years, but does so using a more advantageous methodology. This individual bunches their gift by claiming a larger deduction in 1 year and then bypassing the available deduction in future years. Let's take a look at how that might work. In 2024, our individual has $10,000 of state and local taxes, a charitable gift that they've accelerated of $100,000 in this single year, may be given directly to charity, may be used to fund our donor-advised fund for future distributions in later years. The total deductions available are $110,000, and of course, that will be the number that we claim in that tax reporting year. But look at what happens in the 3 subsequent years. In 2025, 26, and 27, our itemized deductions are limited only to the $10,000 of SALT taxes. The standard deduction of $29,200 is much more advantageous, and that's exactly what's claimed in 25, 6, and 7. The total deductions achieved by giving the same amount of money to the same charity over the same 4-year period of time produces an actual deduction of over $197,000, an incremental benefit of $57,000 to our taxpayer in this example. I hope that you've enjoyed our conversation today. To learn more about tax planning strategies, we encourage you to contact your PIMCO account manager, to visit our website, or to take advantage of the other resources that we've built on this very important topic. Thank you for your time.